The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Chip stocks get their mojo back, and so too does the broader market. Live from Studio 2 here from Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. Kicking off to the closing bell here in the U.S. I am back from San Francisco, and I'm so excited to tell you about what's going on. You can see the S&P 500 higher by about 0.4%. We are seeing, again, that mojo come back, as Romaine said, but fading a little as we get closer to the closing bell. Big tech still higher here, higher by about 0.4% on the NASDAQ 100. The small caps, once again, these are your big winners. It's the little guys. The Russell 2000 higher by 1.2%. And then I wanted to highlight crude. This is interesting, Romaine. You can see that New York crude now below $60 a barrel, sliding almost 5% on the day.
You know, Katie, while you were gone, we did have a bit of a buyer strike in equity markets, at least for a couple of days. And well, some of that was really over some concerns about elevated valuations for tech stocks. For now, that appears to be over. Traders are waiting back in, primarily into semiconductors. This after Taiwan Semi overnight delivered a forecast for a 25% bump in capital expenditures this year. That's more than $50 billion. And that assuaged concerns about the sustainability of data center spending. Chip equipment and material stocks, they're seeing the strongest bids today. Entergis, Applied Materials, and KLA rallying the most since April. We also got some earnings out of the banking sector once again. Morgan Stanley, Goldman Sachs, BlackRock, all helping to boost the market here. A 1-2 punch of tech and financial strength that's aiding a rare day of outperformance for U.S. stocks versus the world. Only the third day of outperformance in the 11 trading sessions so far this year. And today's global pendulum swing, it does suggest the balance of power still remains with the U.S. bulls, both large cap and small, given economic strength, technical tailwinds, and an acceleration in earnings growth.
The earnings power of U.S. companies have essentially outperformed. And whilst we had an exit from the U.S., investors were forced to be pulled back in U.S. equity market because of the earnings momentum.
But of course, the specter of geopolitics, and for that matter, domestic politics, still loom large. The situation in Iran, quieter today than yesterday, but still unresolved. The situation in Venezuela, still in flux, with opposition figure Maria Machado meeting with Trump earlier today at the White House, and the battle line still being drawn over Fed independence. A conversation in just a few minutes with former Treasury Secretary Jack Lew.
Certainly looking forward to that conversation. But let's talk about these markets before we get into the geopolitics of it all. We were talking about small caps, and take a look at the chart behind me. You're taking a look at the Russell 2000 versus the S&P 500, that ratio up top here. And the Russell 2000 has actually been outperforming the S&P 500 for 9 straight days. That's what you're seeing in this bottom panel here. So you bring that back, the number of consecutive days of Russell 2000 outperformance. We haven't seen these types of levels since about 2017 or so. So it's early in the year. And of course, you do have rates rising a little bit here when it comes to just the pure bond market. A lot of questions over where the Fed is going to go next when it comes to lowering rates. So a lot of questions as to whether this can be sustained, Romaine, but certainly we're racking up the superlatives when it comes to this small cap rally.
Yeah, it's been an interesting rotation, and maybe it's a sign to a certain extent of a bit of diversification going on in portfolios coming off that phenomenal run we've had over the last 3 years, led primarily by tech stocks. Jim Masturzo joins us right now, Chief Investment Officer over at Research Affiliates, and he says we're seeing diversification across the board, not just in equities, but in other asset classes as well. Jim, kind of explain what's happening here.
Thank you. It's nice to be with you. We saw this starting last year, right out of the gates. We saw diversification come back. Global equities in particular, right out of the gate, even though U.S. equities in the first quarter of 2025 were kind of, sideways. And then we had obviously the Liberation Day, sell-offs in all markets. But non-U.S. stocks continued to move forward. Over 30% year-to-date returns in 2025. The U.S. did okay at 18%, nothing to sneeze at, but we saw that really strong impetus outside the U.S., partially from the weakening dollar, but also from fundamental growth in those markets.
I am curious, too, about this idea of the idea that valuations, at least for a certain cohort of assets, got so high, and that actually might be driving this search for something that's, I guess, a little bit more, priced appropriately, for lack of a better phrase here. But do you think people are looking in the right places, Jim?
Look, valuations are extremely important. Research affiliates, we're very much into value investing. And so valuations are a key part of what we think about. But the thing about valuations, they're really good at telling us when something is expensive or cheap. They're not very good timing mechanisms. They don't tell you when things are going to revert. So usually when we see a reversion in valuation, there's some catalyst. 2020, obviously we saw, COVID, hit. We saw last April, so on and so forth. These things hit, these events that cause people to remind investors that they're buying things that are expensive and valuations are high. That said, on a day-to-day basis or a week-to-week basis, when we see these little blips, little valuation mechanisms, changes, mean reversions, those are usually just noise. We don't read a whole lot into those.
Jim, I do want to talk a little bit about monetary policy, because taking a look at the notes you sent over to our producers, you said that in 2026, you would expect that central banks will run it hot, basically continue to lower rates here. Does that logic apply to the Fed as well? Because you think about where we stand, of course, there's the political question, but we'll leave that aside for right now. The U.S. economy, a lot of folks have argued, doesn't necessarily look like it's set up to support a ton of rate cuts here.
It's a great point. All of this starts from the debt picture and the deficit picture. And so looking for opportunities, as the Treasury and the central bank are, to address that debt situation. In the short term, that means lowering rates, putting up with higher inflation actually good for inflating away the debt. But also we're seeing weakening in the economy, particularly in the labor markets. Numbers aren't terrible. They're not red, definitely not flashing red, but moving into yellow. Many firms last year did layoffs, announced hiring freezes, those sorts of things. And so from our perspective, we're looking at continued lowering rates, regardless of political pressures, again, putting that aside, at least on the short end of the curve, to address some of these situations. Now, that's going to be good for risk assets across the board. And again, even though U.S. equities will benefit from that, small caps in general, you were just talking about small caps, there's opportunities there. But there's also opportunities in other places from this growth perspective of running it hot.
Well, let's talk about small caps a little bit more, because I asked the question just a couple of minutes ago as to how sustainable this is. So talk us through, when you say there's opportunities in small caps, what are some of the catalysts that you're looking for there?
It's funny, the point of 9 days in a row, which is obviously a relatively small sample size, coming out of multiple years of large cap stocks just trouncing small caps, and valuations in large cap becoming very, very stretched. We tend to look at the CAPE ratio as our metric of choice from a PE multiple. The U.S. large cap market is trading pretty close to 40. The all-time high is 44. Small caps, on the other hand, are still relatively cheap. There's a lot of opportunities across the spectrum of small caps. Investors don't even need to think about, particular sectors or anything like that. Small caps in general look very attractive to us when looking at U.S. equities.
What's the big risk, though, Jim, right now, when you look at sort of this rotation into some of those asset classes? Do you see any potential risk, whether it's on the economic front or the geopolitical front? Where?
Well, look, geopolitical is on top of political and geopolitical are on top of everything that's happening today. Oil prices selling off massively today because it sounds like the administration has decided not to attack Iran. Well, that could change tomorrow. That could change over the weekend. So these geopolitical events are always happening, and to the impact of that on the economy, whether that slows the economy, takes us into recession, that's going to weigh on all risk assets across the board, no matter what they are. So those events are incredibly important. I mentioned the labor market. The labor market to us is still yellow. It's not flashing red. But if we see the labor market rise as we go into recession, consumer spending falls, well, again, across the board, we're going to see a problem with risk assets. But these aren't our base cases by any means.
So you've highlighted the labor market a number of times, and I do want to point out we are getting our way through big bank earnings. Wall Street apparently eliminating nearly 11,000 jobs last year. That is the most since 2016 or so. Labor market, of course, that's a focus for you. What about inflation, though? Where does that fall on your radar, especially as you try to keep track of where this economy is going?
So, unfortunately, I've started to say that 3% is the new 2%. Prior to 2021, everyone talked about 2% inflation. 2% was the target. That's what we wanted. If we were higher than 2%, there was a lot of nervousness. Now, 3% seems to be the norm. We get readings below 3%, as we just did earlier this week. And, there's kind of euphoria or at least, happiness. And so we've switched our mindset to sort of tolerate, higher inflation. Over time, that's going to cause problems. Higher inflation also comes with higher inflation volatility, which leads to just volatility everywhere. And so when we're thinking about building portfolios, we can also lean into assets or strategies that do well when volatility is elevated. Trend following, alternative risk premia, a lot of the quant-focused strategies tend to do well from higher volatility, which can come from macro, geopolitical, as well as inflation.
Jim, always great to catch up with you here. We have to leave it there. Jim Masturzo is the Chief Investment Officer over at Research Affiliates, kicking us off to the close here on this Thursday afternoon. And when we come back, we're going to hear from former Treasury Secretary, former Deputy Secretary of State, former Ambassador to Israel, former White House Chief of Staff, former U.S. Budget Director Jack Lew, to talk about all the political drama going on in Washington.
And then from policy to profits, JPMorgan Chase Chairman and CEO Jamie Dimon sits down with David Rubenstein, Carlyle co-founder and host of Peer-to-Peer on Bloomberg Television, to discuss how the bank giant is navigating those economic crosscurrents. And we're going to end on a high note and discuss high-end spending in the auction space. You want to buy a Secretariat saddle or, Jerry Garcia's guitar? Well, we have a chance to catch up with Brennan, the CEO over at Christie's. She's got a lot to say about the auction slate for 2026. Stick with us. This is The Close on Bloomberg. Crypto firms feeling the heat after the Senate Banking Committee delayed discussions around a widely awaited digital asset bill. Now, this delay, it came after Coinbase decided it would not support the most recent iteration of the bill, citing issues with restrictions around offering yields or rewards on its users' stablecoin holdings. Joining us live to discuss what's at stake is Olga Kharif. She is senior crypto reporter over at Bloomberg News. Olga, great to have you with us. Talk about the importance of Coinbase here, the significance of them pulling their support, because it seems like that was really one of the watershed moments here.
Absolutely, it was. So crypto firms, including Coinbase, which is one of the leaders of this industry as the largest U.S. exchange, have been working on a market structure bill for 4 years or so. This bill is super important to them as it defines sort of and legitimizes regulation of this industry. And so it was very surprising when Coinbase pulled its support on the bill. But essentially, the company ended up having a lot of concerns about the text that was released on Monday and didn't feel like the amendments that were proposed would sort of solve the issues. So that's why the markup of the bill has been delayed from today. Yeah,
I'm curious whether, Olga, this is just more kind of a negotiating tactic on the part of Coinbase, particularly given how much impact they had in the most recent election cycles with the donations that either they gave directly or managed to sort of pool together from some of their other industry peers.
So that's a great point. The industry really needs this legislation to ensure that with any changes of presidential administrations, it's safe from being targeted, for instance, by the SEC, as it was under Biden. So the industry really needs this. So it could be a negotiating tactic. There are hopes that this bill will be revised and will be marked up in a few weeks. Yeah. We'll see what happens, but there's the danger that this delay could last and the bill will not make it through this year.
And so at this point, I mean, how does the U.S. compare to other markets? As we know, crypto, of course, is one of the most global asset classes out there. And you think about the state of our regulatory environment, how does that compare to what we've seen in Europe or Asia, for example?
So some other markets have a much better defined regulation and of the crypto market. And so we've seen in recent years, we've seen some developers and companies moving overseas. This sort of halted under the crypto-friendly Trump administration. But, you know, if this bill is not done, this could be temporary. And under another administration, we could see another outflow. So the crypto industry really would like to have some permanent certainty, if you will.
Yeah. All right, Olga Kharif, senior crypto reporter over there at Bloomberg News, as we keep an eye on the Genius and Clarity bills, trying to work their way through Congress. A bit of a speed bump as Coinbase pulls out for right now its support of the bill. Maybe potentially a tweak to language brings them back on board. And, you know, Katie, you were gone for the last few days covering this big healthcare conference that I heard took place. Did you know that former New York Mayor Eric Adams came out with his own crypto coin? It caused quite a stir.
You know,
I don't know if it hit you out there in San Francisco.
No, somehow it reached me all the way across the country, that meme coin from Eric Adams. I heard it's not doing too hot.
Yeah, it's not doing too hot. I can't even find pricing for it today, but it had basically gone $1.5 to $600 million in valuation, down to about $10 million as of yesterday. And as of today, good luck trying to find any kind of accurate pricing on there.
Well, you know,
there's a word for this, or a phrase for this.
What is it?
I don't know. I'm not going to say it on air.
Fair enough.
All right, when we come back here, we're going to move from crypto and, well, into the trucking space. We're going to talk about the real economy here. We're awaiting earnings after the bell out of J.B. Hunt. We're going to talk about what to expect out of that company and what kind of read it provides us on broader economic conditions. This is Bloomberg. Time now for our top calls. The big movers on the back of analyst recommendations. We start off with Albertsons. Morgan Stanley downgrading to underweight, setting a street low price target of $14, with the analysts saying the intensifying grocery wars leaves traditional chains like Albertsons at risk. Those shares, which had rallied about 3% yesterday, giving back some of that today. Up next, SanDisk. Benchmark almost doubling its price target to $450 from $260, maintaining a buy rating. The firm says rising prices for the computer memory market will push up margins for the company to record levels. Those shares, which are already up more than 70% this year alone, 6.5% of that coming today. And finally, take a look at Boeing. Bernstein's price target taking flight, raising to $298 from $277. Boeing, that's the firm's top U.S. aerospace and defense pick for 2026. Analysts citing a ramp up in production for the 737 and 787 commercial jetliners and improvement in the company's defense business. Boeing shares, which had rallied 38% in the last 5 weeks of the year, starting off the first 2 weeks of the year, up 14%, including 2% today. We do want to go from planes to trucks. Truck carrier J.B. Hunt is scheduled to report earnings after the bell. A lot of people looking for whether we've actually seen the bottom in the trucking market and whether economic conditions could provide some optimism going forward. John Chappell joins us right now, Senior Managing Director of Transportation Coverage over at Evercore ISI. John, great to have you here on the program. What are your expectations for tonight? Do you think we're going to have any sort of meaningful upside guidance out of the company?
Thanks for having me, Romaine. So it's a couple things we're looking for tonight. First of all, is obviously the fourth quarter results. There was a strong seasonal spike that was exacerbated by weather in December in truckload rates, which then translate typically into intermodal with a bit of a lag. So the things we're looking for most closely for J.B. Hunt are how are the volumes as a more of an indicator for the broader economy in the freight market? How is the pricing? Are we finally lifting off a prolonged bottom? And then also more importantly for J.B. Hunt specifically are the cost initiatives that they announced back in July that led to a tremendous beat in the third quarter. Are those continuing and leading to margin upside in the fourth quarter as well? As we think about 26, J.B. Hunt will likely remind us that there is a seasonal step down in first quarter. And then also just kind of a state of the union on this December spike. Do they see it as being sustainable? Is capacity really leaving the market in droves? And are we finally ending a 4-year downturn in the freight market?
I am curious about the intermodal side of the business. I mean, that's at least half their revenue here. We've seen an improvement in rail service over the last couple of years. Does that show up in the report tonight and more importantly in the guidance going forward?
It probably doesn't show up tonight and not in the first quarter as well. You're correct in stating that the rail service is about as consistent and reliable as it's been in almost 20 years. And most constituencies are telling us that, from shippers to the employees themselves. Now, what's most important, I think, is the commentary around the second half of the year. Remember, this time last year, we were going into a tariff environment, and there was a very aggressive pull forward of goods. So the reason I don't think you'll see the impact of the better rail service or even an uplift in the economy is we're still anniversarying these very difficult comps. As we clear March and April, when the tariffs were implemented and when the pull forward really started to slow, then I think we'll get a more reliable view on the underlying economy and the consumer health, as well as the rail reliability in the back half of the year.
And I just want to talk about, John, just what we're seeing in the shares. You think about the numbers that we're going to get tonight, how they're going to be received by the market. JB Hunt shares are higher by nearly 41% on a total return basis over the past 6 months. A lot of those gains starting in about mid-October. I mean, how high do you think expectations are going into this print?
Yeah, it's a great question, Katie. 50% in the last 3 months since they reported last. So it's a couple things. Again, fourth quarter, I'm expecting upside there. There's very company-specific cost initiatives that, again, led to the upside in 3Q, and I think we see them again in 4Q. Typically, you would see the intermodal margin deteriorate modestly just from a seasonal perspective, 3Q to 4Q. I think it'll be better. So that's where the upside comes from. Now, again, they're going to remind us about seasonality so we don't get ahead of our skis on 1Q. But I think the commentary about the broader landscape, demand, and capacity as we think about 2Q going forward should be relatively optimistic. They tend to be more balanced, a little bit less promotional than some of the other management teams, which I think is a good thing. We don't want to overpromise and underdeliver, again, as the industry's been doing for some time. But I do think that there's going to be some green shoots that they can speak to specifically that probably justifies that 50% move over the last 3 months.
We have just about a minute left, but to your point on seasonality, how do you think a JB Hunt is positioned to handle some of those seasonal factors as compared to some of their peers in this space?
Yeah, I think the company-specific cost initiatives that they're putting in will help them a little bit. So $100 million they announced in July. On a run rate basis, they had already achieved about 80% of that through September. I think they may identify even a greater total, so that 100 becomes 100 plus. When they announced this afternoon, that should stem a little bit. Now, the seasonality that we typically look for is a 20% EBIT pull down from 4Q to 1Q. Last year, it was about 15% down, and I think it could be something much better than 20%, though they still may guide to it to keep expectations nice and low.
All right, John, great to get some time with you ahead of those earnings. That is John Chappell. He is Senior Managing Director over at Evercore ISI. Now, coming up, former Treasury Secretary Jack Lew joins us to discuss the future of Fed independence. We'll also get his take on the state of geopolitical tensions, given his background as the former U.S. ambassador to Israel. That conversation next. This is The Close.
3:30 p.m. in a sunny New York City. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, keeping an eye on these markets, also keeping an eye on the Federal Reserve and the question of independence, of course. I'm sure you spent a lot of time talking about that DOJ investigation into Fed Chair Jerome Powell.
Yeah.
And a very interesting letter with some big signatories basically coming up to support the Fed chair.
Yeah, they put this out on Substack, and it was, we've heard a lot of Fed officials and former Fed officials really come out and banging the drum. But this letter was remarkable for a couple of reasons. I mean, you had at least, you had the three living former Fed chiefs, Ben Bernanke, Alan Greenspan, and Janet Yellen sign off on this letter. But it was also an interesting hodgepodge of other people from other administrations from both sides of the aisle. Phil Gramm, who used to run the bank, a Republican, used to run the banking committee. Glenn Hubbard, Greg Mankiw, Christina Romer was on this letter, Bob Rubin, and also Jack Lew, of course, who was Treasury Secretary and then, of course, Chief of Staff for the White House for a few years.
That's right. You had four former Treasury Secretaries sign on to this letter, and I'm pleased to say that one of them joins us now. His name is Jack Lew, as Romaine mentioned, former Treasury Secretary and former U.S. Ambassador to Israel under President Obama, now currently a professor of international and public affairs at Columbia University. Secretary, fantastic to have you with us. I want to start with the first line of this letter, that the Federal Reserve's independence and the public's perception of that independence are critical for economic performance. And it's that part I want to talk about, because that's something we basically take as gospel, that the independence of the Federal Reserve really matters for this economy. But Secretary, tell us concretely why exactly that relationship exists and is so important.
It's good to be with you. And that sentence is really the core of the reason that so many of us got together overnight to sign that joint statement. And it's the reason you see central bank governors around the world and people from the Republican Party in Congress and former members joining as well. The confidence that the public has in the Fed is crucial to expectations and the ability of the Fed to use its tools in an effective and a convincing way. We've learned the lesson from international experiments with central banks that were not independent. And it's not a good history. And as Treasury Secretary, part of your job is to help other countries understand that they're not going to help themselves if they have their central bank subject to political controls. I remember when I was at Treasury, that issue came up in Turkey. It didn't end well for Turkey when they had political decisions made on their monetary policy. I mean, their inflation rate has been roughly 10 times ours. So these are core issues in terms of the stability of the U.S. economy. I actually think that it settled the nerves of markets and observers that so many people came out to say that this was not an acceptable way to treat a central bank. And we can talk more about the specifics of it. But if you view this not as a question about a building improvement, but using legal prosecution to try to put pressure on a central bank chair, that's a terrible precedent.
I am curious, though, just about this idea of trying to affect policy as the White House is trying to do. And there's always been this interesting relationship between the Treasury and the Fed, particularly given the Treasury, or at least the Treasury Secretary's link to the person in the Oval Office. I am curious as to why you cannot achieve your aims as president through mechanisms other than the monetary policy mechanisms that this administration seems to be so focused on.
So I think every president has views on where interest rates should be. Every Treasury Secretary has views on where interest rates should be. And there's nothing intrinsically inappropriate about sharing those views. When I was Treasury Secretary, I had a weekly meeting with Ben Bernanke and then with Janet Yellen, and we shared confidential views on everything from fiscal to monetary policy to geopolitical issues, to whatever was on our minds. The question is, are you trying to pressure the central bank to make decisions that are not based on the central bank's independent judgment, based on the data? Right now we're at a time where the data is not straightforward. You could see in the outcome of the last Fed meetings, it was a close call. There will be differences of views. The question is the judgment being made based on the central bank's best understanding of the data, or is it a politically driven move which is suspect in markets and around the world because it doesn't reflect that independence?
Well, Secretary, you made an interesting point that you think about this specific incident, this specific probe into Jerome Powell, that it seems like markets basically shook it off because, as you said, there was a lot of pushback from both sides, basically bipartisan, expressing discontent with this move. And I wonder, what the recourse is here. If we continue down this path of eroding Fed independence in a meaningful way, whether or not it'll be markets that will be sort of the ultimate disciplinary action here.
Look, I hope it doesn't get to the point where we have to see the market response to kind of a clear demonstration that it's crossed the line. The fact that overnight it was not just a group of Democrats. You had former Secretary Hank Paulson, you had Greg Mankiw, Glenn Hubbard, Phil Gramm signed on. I think that says a lot about broadly held the view is that inappropriate political pressure and coercion on the central bank is not a good thing. So I'm hoping that the response to it is a bit of a lesson.
Yeah. But Jack, can I just stop you there? Because, I mean, you raise an interesting point here about the signatories on this. But I do want to sort of draw some distinctions between some of those names on the list, which are certainly, no offense, people from a different era of how Washington worked. And we're now looking at a Washington that's run by a completely different cohort of people who sort of look at the cooperation and bipartisanship that was kind of a hallmark, particularly when you were working in Congress, whether it's for Tip O'Neill or for the liaison group with Greenspan, solving Social Security. These were sort of bipartisan efforts. And that bipartisan, as I'm sure you know, that bipartisanship seems to have completely dissipated from Washington. Do you ever see any hope that we will see a little bit more cooperation amongst the administration, Congress people, and other folks out there to get things done? Or is this sort of distinct bifurcation that we've seen over the last a few presidential administrations just what we're going to have to live with?
I sure hope we do see a return to some bipartisanship. Obviously, this is not a moment where one would seem very realistic to say it was immediately on the horizon. But the challenges we have as a nation need to be faced in a bipartisan way. I mean, you look at something like Social Security. I was a young aide to the Speaker of the House, the liaison to the Greenspan Commission. I am proud to this day of having been part of solving Social Security's fiscal problems for more than half a century. Now, we're less than 10 years away from some action having to be taken. I hope we don't wait until we're 6 weeks away. That won't leave great options. It can't be resolved except in a bipartisan way. You look at our overall fiscal position, it's going to require bipartisanship to come up with some mix of measures. To talk about raising taxes right now, one would sound like they were from another planet. But that's going to have to be part of the conversation, as will some action on spending. So to put everything on the table means everyone has to come to the table. And we haven't had that bipartisanship for a while. I will say this about the 1980s and the 1990s. I remember both decades being seen as the most partisan ever. I remember when Bill Graham was a Democrat, when he left to vote for the Reagan economic program. I worked for Tip O'Neill at the time. I remember when we faced the government shutdowns with Newt Gingrich, and just a couple of years later, we're sitting at a table passing the balanced budget agreement. So you can come back from the brink of partisanship. I hope it doesn't take a crisis to bring that about.
Well, getting back to the broader question of Fed independence, I do want to point out that you think about what's going on with Fed Governor Lisa Cook. You were part of the group of Fed and former Fed and Treasury officials who signed a friend of the court brief in September in support of Governor Cook, who Trump is currently trying to fire. And I mean, I do think it's interesting that this extends beyond just the Fed chair himself and jawboning about interest rates and the direction that the president would like them to travel. It extends to the Board of Governors as well.
Look, I think it's a very important question that's going to come before the court very soon. I hope that the court, continues, as it did in a footnote in a recent case, to say that removal of Federal Reserve Board members can only be for real cause. And that's not been proven in the case of Lisa Cook. I think reaching to a kind of strained investigation into perjury, anyone who's testified before Congress has answered questions to one degree of fullness or another. It takes way more than somebody saying you didn't fully answer my question to even get close to that. So the notion that this investigation is going that way, to me, just suggests that legal tools, prosecution, is being used to send a signal, and it's very important for there to be a counter signal. The Fed has to be treated in a way that respects its independence, and it can't be coerced through legal attacks.
All right, Mr. Secretary, we're going to have to leave it there. Really appreciate you taking time for us here. Obviously, a very important issue and one that's still yet to be resolved, and of course, a big Supreme Court argument coming up next week regarding Lisa Cook and the president's power to remove a Fed governor. Jack Lew, former Treasury Secretary and former U.S. ambassador to Israel. Katie, talking about Fed independence. And, we should just point out, just today, we've heard from more Fed officials on this, Austin Goolsbee. And I also just wanted to just remind our viewers and our listeners here, Stacey Vanek Smith, she has a great podcast called Everybody's Business. They actually caught up with Janet Yellen, the former Fed chair, for an interview. I believe that's going to be released tomorrow on Friday. Definitely going to listen to that.
Yeah, and I thought the secretary made a really interesting point that the fact that you did have that immediate wave of pushback seemed to soothe markets. Again, I have been in San Francisco this week, so haven't been paying.
Which is like being in a different country.
It kind of felt like it, but to see basically the reaction and wondering why they shrugged it off, I think it speaks exactly to that point. But it will be interesting to see how markets continue to behave should we go deeper and deeper down this path. Absolutely.
Well, speaking of markets, a bit of a turnaround from what we saw over the past couple of days with the S&P 500 in the green. Modest gains up about 0.2%. One of the biggest gainers in the S&P today, that's actually BlackRock. The share is rallying after the company's total assets hit a record $14 trillion, helped by its bustling ETF business. Joining us right now is Norah, Mulinda, our Bloomberg's markets correspondent. Talk a little bit more about the outsized move here. In fact, best day going back to Elisa, April here. Obviously, the ETF business has been on fire. It's been on fire for a while, but this is a little bit of a different story from what we saw from some of the other financial companies that have reported this week.
Yes, this is a bit different. $14 trillion, that's not a small number that we're talking about. We know that ETFs have really been their core moneymaker. If we think about the fact that they're low fees, tracking the major indexes, so you see a lot of popularity from that. But what's been really interesting to me from this report is that we've been seeing a large push from Larry Fink from the business into private markets, which we know has really been a bustling area or an area that people are really trying to expand out into. And that's where they've been placing a lot of money, about $28 billion that they spent in acquisitions from a number of companies, GIP, HPS, also Preqin. They're really trying to put their stamp there, and we're going to have to see whether or not they're actually going to be one of the forward leaders in that.
Well, it's interesting. You mentioned that BlackRock is known for its ETFs, which tend to have pretty slim margins, to your point. They tend to be low cost. That's what the industry is known for. When it comes to private credit, though, and private assets in general, when you put those into different fund structures, you can charge a lot more. So the margins get a little bit better. But it's interesting sort of to talk about BlackRock because we're in bank earnings season, and BlackRock, of course, reports at the same time as these banks. And when it comes to earnings season in general, there's been some concern when it comes to spending by Wall Street. What are we hearing there?
So we did see that expenses were up for BlackRock, but not to be a major concern for a lot of analysts here, especially given the fact that they're for strategic reasons. And that's going back to that push out into private markets that they're really trying to illustrate and get going there. So we did hear from a lot of different banks where we did see that expenses were up, especially because a lot of them were really writing on severance packages, job cuts. But we're not really seeing that being a problem area as much for BlackRock in comparison to its competitors.
All right, Norah, really appreciate you reporting. That is Bloomberg TV markets correspondent Norah Mulinda. And I do want to point to an article I managed to put out while I was in San Francisco.
Wow.
Helping to break the news.
They have internet connection out there?
They do.
Okay.
The Wi-Fi, it's a little sticky, but still managed to find a connection. BlackRock breaking the news that they're cutting hundreds of jobs, trimming about 1% of staff, which only translates to about 250 employees firm-wide. But you consider the fact that they instituted 2 rounds of job cuts last year as well.
1%?
Yeah.
Okay.
Yeah, they're not alone in this, though. Wall Street overall eliminated more than 10,000 jobs. At least that was reported this latest quarter. Was Amanda Lynham part of that 1%? I don't think so, but that's pretty big news that she's going to Goldman. Yeah, big story there. BlackRock's Amanda Lynham going to be chief credit strategist over at Goldman. Yeah. Anyway, how is San Francisco? Is it clean? I hear they really clean it up for this conference. It's just they just shoot away all the riffraff for 1 week. Yeah, and I don't really explore the city, but what I saw looked great, Romaine. You'll be happy to hear. You did not explore the city, really? No. Okay. No. All right, you sure? You didn't get out? I was too focused. Sightseeing. Too focused. I was dialed in. All right. Well, we are focused here on the market with those closing bells just about 14 minutes away. David Bahnsen going to be joining us after the break. Stick with us. A lot coming up here on the close. This is Bloomberg.
Just about 10 minutes until we get to those closing bells. Romaine Bostic here alongside Katie Greifeld. A strong start to the day for U.S. equities, Katie, but seeing a little bit of a fade as we get closer to the closing bells.
Yeah, not a lot of enthusiasm out there. You can see the S&P 500 still higher by about 0.3% if you round up. I will note that volume higher than it has been over the past 30 days or so. But it's interesting to see that sort of impulse just drag on as the day does too.
Yeah, I don't think we have the numbers on the board there, but we're up about 0.2% now on the S&P. But the outperformance by the Russell, that continues to be a big story here, up about 1% on the day. Mid-caps up 1.3, transports up 1.8. And that gets to this idea that money's still staying in this market, just maybe looking for a relatively different home, at least when it comes to valuations.
Yeah, absolutely. I mean, we talk about small caps so much on this program in recent weeks, but it bears repeating. I mean, you think about the small caps versus the S&P 500, 9 straight days of outperformance. We haven't seen that in years, and I don't necessarily know what the catalyst is right now, because for so long it's just been a bet on the Fed lowering rates.
All right, well, let's pose that question to our next guest here. Maybe he sees a little bit more of a reason for those moves. David Bahnsen is the Chief Investment Officer at the Bahnsen Group. He joins us here in Studio 2 with just about 9 minutes until the closing bells. Can you actually explain kind of the newfound interest in a lot of these small and mid-cap stocks?
Yeah, here's what I would say. The most important thing is that the market never needs a reason. And so we can talk about what the reasons are. I think a lot of them are just gravity related and the pull of certain relationships getting so distorted. The big cap and small cap relationship was way off. It can stay off for a long time. It did. This didn't start this year. Katie's right. I think 9 days in a row, she said. That doesn't happen often, but this was happening a lot in December. Not 9 in a row, but 6 on, 4 on. I mean, you got a trend going there. It's not just small cap either. It is the even weighted versus cap weighted. It is value versus growth. It's some of those out of favor sectors. And the correlations within the market right now have got to be very, very low, because I'm seeing things on a screen. It looks like today we're going to end up being somewhat flattish. S&P 20 to 30 bips. There's tons of names up 3, 4, 5%.
Well, this funny thing is about that, as much as we kind of nitpick and scrutinize this, there are a lot of people who say this is actually a good thing, right? To a certain extent, this is how a healthy market should actually be operating.
Yes, it's been a theme of ours for a while, a rotation, not a correction. So much of our time as investors since the financial crisis has been in risk on versus risk off periods. A correction hurts everything. A rotation just simply means a change in leadership. If we were to look at the trailing 12-month returns on Mag 7, people would be shocked at how low they are, besides NVIDIA and Google. I mean, you're talking about low single-digit returns on some of these names.
Oh, I've looked,
Yeah, it is a good point that, we tend to talk about tech as a monolith, but there's been a lot of dispersion there, especially if your name isn't NVIDIA. But that being said, how are you feeling about big tech, the state of the AI trade? Because it seems to be wobbling a little bit over the past few weeks, or at least there's been more questions as to how long this can run.
Well, look, NVIDIA's high was October 29th. It's a few months now, and I think you're going to end up looking at very muted returns in 26, best case. It also will be a high dispersion of results. You notice now all of a sudden CoreWeave is rallied again. Oracle is still way down from its September high. That's what I expect, is you're going to see some winners, some losers, because people have to get off of this idea that they're all going to win. That was always a ridiculous idea. This is really a trade that people have to start looking at with the specific ingredients, and I think that there's a lot of question about the circular funding model out of AI CapEx.
Yeah, certainly, and those questions are going to be coming back to the forefront as we get deeper into earnings. But let's talk about potential winners here, because that's a lot of fun. I see in your notes that the energy sector, in your view, a solid contrarian play in 2026. Tell us what you're seeing there, because I feel like energy is one of those sectors that if you're a tourist, if you're not like a pure play energy investor, it's easy to get overwhelmed.
Well, look, my point with being contrarian here is not that it will be the top performing area. It's that when people leave it for dead, it can be a very surprising performer. The last time energy was 2.9% of the entire S&P, when it spent most of my life being 10 to 15%, was in 2020, and it proceeded to then go up 120%. the sector is just too low weighted within the overall market. So whether it's upstream, midstream, combination across energy, I think you get a repricing that's attractive for investors this year. We've already seen it a little bit. So some things have priced up quite a bit. The integrateds, your Exxon, Chevron, some of this is Venezuela related. But no, the midstream area continues to have really attractive yield spreads.
I am curious just about the general nature of geopolitics. You mentioned Venezuela. There's a lot of things going on. I know they haven't had a huge impact on the market, at least not a lasting impact on the market. But do you sort of factor that into, I know you're kind of a bottom-up fundamental investor, but when does it become a bottom-up fundamental kind of story, some of these issues?
Because the top-down geopolitics does affect bottom-up.
Yeah.
And so that's the area that we as portfolio managers have to look to. Chevron there is a good example. We want a base case where we like the valuation, and then you look for things that we might want to weight it a little higher in terms of some of those particular top-down issues. Chevron's going to be a winner out of the Venezuela story. They were already reasonably priced. Both Exxon and Chevron, I think, made acquisitions during COVID that have never really gotten priced in. It took a little while to integrate, but between Noble and then Hess, Exxon as well, their balance sheets always enable them to pick up market share. They benefit from that, not for a year, but for 10 years.
Yeah.
And so there's a lot of benefit in the integrated. But I would argue the midstream's the story no one's really talking about. People love to hate midstream.
Yeah. And I mean, and then the thing with Venezuela, I mean, you can sort of draw a line as to who potentially benefits from that, whether you agree with what's going on politically. Similar story when it comes to what's going on in the defense space because of some of the conflicts overseas. But come back home here in the U.S. and all of the talk right now about Fed independence, this idea that no matter who's sitting in that chair come June, at the June meeting, that he or she is going to be way more dovish by default than Powell, or at least the perception than Powell was. Do you worry at all about the decision-making process at the Fed based on all the politics around it?
It's not so much that I don't worry about it as much as I've already accepted the fact that this president gets to pick the next Fed chair, and this president is not going to pick a Fed chair who is not going to cut at least twice after they come in. And so we know that.
Always a reminder, too, he also picked the current Fed chair.
That's exactly right. And
I know he doesn't think you did, but he did.
But no, he did. And that, to me, reiterates my point as to how in his mind, I'm not defending it because I'm very much against the way the president has handled all of this. But in his mind, he feels, I made that mistake, I won't make it again.
Gotcha.
Ultimately, I believe that Fed independence is a very important thing. There's a lot of issues here that complicate it, but he's not going to fire him. And whoever is there is going to cut rates, I think, twice in the second half of the year. That's already in the Fed futures. The bigger question is the year after. Okay, when that immediate political expediency is not as intense, and then we have different data that may or may not call for a different action. I don't think you're going to do a lot of damage taking 50 more out of the curve. But if you are cutting once you're already near around the neutral rate, around 3-ish, and if you are at good GDP growth, to me, if they're cutting next year, you better be in recession.
Well, that's something I wonder about, what the market reaction function looks like. Because, okay, let's say we get 2 cuts next year. Let's put aside what happens the year after that because there's so many unknowns. But let's say we get 2 cuts next year. There's no guarantee that, the long end of the Treasury curve is going to cooperate and move lower. I mean, we saw that last September as well. The Fed came out with a jumbo rate cut and the long end shot up. So if the economy, if the data is in a place where it doesn't support those at least 2 cuts, how do you think the market reacts?
Well, the Fed should not be cutting based on trying to control the long end of the curve. The Fed's job is not the long end. The long end is telling us what the economy is doing. The 10-year is the best barometer to measure expectations for nominal GDP growth we've ever had. And the reason we're around 4% right now has nothing to do with the Fed on the 10-year. It's because the inflation is 2 to 2.5-ish, and real GDP growth is 1.5 to 2-ish. That's basically the math of this. I think the 10-year is going to do what it's going to do, and there's no central bank I've seen that's been able to control the long end. So that isn't really going to be the issue. The short end, though, is where you can do a lot of distortion in asset prices and create malinvestment, create bad decisions because they've overstimulated with the short end.
All right, David, always great to get your insights.
Thank you so much.
David Bahnsen, Chief Investment Officer over at the Bahnsen Group, counting you down to those closing bells. Just about well, 30 seconds to go, Katie Greifeld, and we are well off the highs of the day. In fact, near session lows, but still green across the screen for most of the major indices here. A bit of a turnaround from the last couple of sessions. Absolutely.
And the small caps, again, let's shout them out because you've seen the enthusiasm fade at the big index level, but the Russell 2000 is still higher by more than 1% right now, Romaine. As we get the closing bells in New York, the cheering and the clapping begins here, and good reason for it. The Dow Jones Industrial Average is going to add about 0.6% here on the day, up more than almost 300 points here on the day. The S&P 500 adding about 18 points or 1/4 percentage point. The NASDAQ Composite also up 1/4 percentage point. The NASDAQ 100 up about 0.3%. But the real stars of the show, you're going to find that in the equal weighted S&P 500, that's up about 0.5%. Transport's up 1.8, mid caps up 1.2, and the Russell 2000, Katie, up 0.9%. And it's interesting, even though at the S&P 500, you didn't exactly see that big rally, breadth was pretty good. You had more than 300 names actually finish in the green, even though the index as a whole was only higher by about 0.2%. A big focus on the markets, and of course this week, a big focus on bank earnings. The CEO of JPMorgan, Jamie Dimon, well, he's sitting down right now with our very own David Rubenstein at the U.S. Chamber of Commerce. Let's listen in.
I guess it's about the 700%. And your stock price up about 500% or something like that?
Like 1,000%, but go ahead.
Right. How much?
We paid back, bought back a lot of stock and paid a lot of dividends and all that, so yeah.
So it's pretty good, so people are very happy. And so the question you get asked every day, 5 times a day, is how much longer do you want to do this? And the answer is 5 more years?
Yeah, at least.
About 5 more years?
I love what I do. It's up to the board how long I do it. As long as I have the energy and the spit in the eye and the fire in the gut, yeah, I want to do it.
Okay.
Yeah.
So you recently built a new building in New York. Why did you decide to build your headquarters in New York? You tore down the building you had, built a new building, took a couple years and cost maybe $3 billion or something like that, and it's now open. Are you happy you made that decision, and are you going to build a similar building in London now?
Yeah, we are. So if you look at what we have, we spend $40 billion a year on people, which is important, $4 billion a year on real estate. We want to have great real estate. The old building wasn't fit for purpose. It was too small, couldn't handle our trading floors. I looked everywhere. I looked downtown, I looked at Hudson Yards, I looked at buying Vanderbilt, but we could tear that building down, we could buy air rights. You know, I thought it was the best location in the best city, and then we should build it there. We're quite happy we did it. It's beautiful. It's got 14 places to eat, got Morgan's Pub, Guinness beer. It has sushi bars and hamburger and daily provisions. People like Danny Myers helped us make sure it had the right vibes when you go there. It's got sweet greens, 8 trading floors, full city blocks. Yeah, it's a beautiful place, and people like going there, and people are bringing their moms and dads and kids to show it. When you walk in, it's also got a big American flag up front blowing in the wind inside. And so, yeah, I love it.
So recently, you've been talking about the importance of the United States, and are celebrating our 250th, but also investing in things that are security related. What made you focus on that? And you're now going to commit, $1.5 trillion over the next 10 years for this kind of investment. Why did you decide to do that?
Yeah, so I've always been a patriot, and like you talk here about growth. Growing the economy and the grievances of America, which is a lot of legitimate ones we've got to deal with and get policy right. But one of them was this notion that we ended up being so reliant on other people, some potential adversaries, for things critical to the security of the United States. And it wasn't just us, it was our allies too. So we did some real research across 28 industry groups, and you're talking about rare earths, which you all know about, active pharmaceutical ingredients, which some of you may know about, obviously military production, drones, air, cyber, satellite. What are the things you need for resiliency? That we already did a lot of it, and we wanted to do more, realizing it was an important thing to do. How we got here, I don't like crying over spilled milk, but we should never have been here. So that's $1.5 trillion. My guess is it'll be quite a bit more than that by the time we're done. We've had a deluge of interest in it. Then we hired Todd Combs, who's just a world-class investor and a world-class person who's got his own deluge coming in to invest, $10 billion and probably more, and we certainly probably have partners in that, in helping companies with growth capital that they need to grow, to build the next plant or something. We did real research on supply chains. There's a lot of companies that provide what's important for our basic important military equipment that need help to grow. They could be private companies or bigger companies. There's a venture capital component. We're also going to do research. So think around the shipbuilding ecosystem and policy. There are a lot of things that are wrong or policy reasons, how we're allowed to procure in the military, things like permitting, EPA laws. If you want to keep this country safe and secure, we need to do this work. We need to do it now and right away. It also will be extended to, nations in Europe, Australia, Japan, South Korea, Australia, et cetera. And it's just important we do it. National security. If you didn't get the wake-up call in February when 300,000 Russian troops invaded Ukraine, the world's not safe. It was never safe. We just got lulled into a false sense of security. The biggest safe thing to have is the strongest military on the planet.
So, Jamie, you went to Harvard Business School, graduated as a Baker Scholar, top 5% of your class. You could have gone to Goldman Sachs, Morgan Stanley, all the famous firms. You chose to go work for a person who was a friend of your father's. Name is Sandy Weil. You did that, and then when Sandy left, you stayed with him, and then ultimately you guys went to Citicorp, and then he fired you. And did you ever think then that you'd be coming back and running the most important bank in the world at the time you got fired there, or what were you thinking at that time? And I said you should come into private equity. I went to see you, and I said, why don't you come to private equity? And you didn't seem that interested. But
the biggest money offer I ever got in my life was from this guy over here. It was never about money for me, and I knew after I got fired that they were going to screw up Citi, because I knew how stupid some of the things they were doing was. But no, I didn't think that way. I just, I took time. I thought about all these various alternatives. I spoke to a lot of people, and then I went to Bank One. I loved the Home Depot guys. They were talking to me, but I had to confess to them when I walked in, I'd never been in a Home Depot until my friend made me go that weekend before I had dinner with Arthur Blank, Bernie Marcus, and Ken Langone. And I just loved their culture, but I'd never been in a merchant business, and I'd been on, kind of the Wall Street trading, insurance, et cetera. But Bank One was there. I thought it was going to be tough. I put half my money into it. I moved my money to Chicago. I love Chicago. And all I thought about is just do the best you can. I mean, I don't like it when senior people complain. I always had a no whining sign. Suck it up and do the job. That's all it was. And I just go about the work. And division by division, person by person, department by department, tech by tech, try to build something great. I had my eye on JPMorgan Chase, and a couple of years, I thought it would never happen because we were so small and not doing well. But 4 years later, we had done a good job at Bank One. The values were close enough. Bill Harris and I know each other. We merged the two companies. Then I had a dream that if we did it right, we could make this a great company. Then I really did. Like that was.
What do you think is the most important thing you did that put JPMorgan ahead of every other bank in the world? What is it? Is it that you worked harder? You hired better people around you? What were the things that you think the most important thing that made JPMorgan what it is today?
First of all, a lot of people do things better. So to say we're the best and everything is not right. And I think that's one of the reasons sometimes we do better a little bit, which is, I'm relentless. Detail, facts, analysis, no bullshitting, no meetings after meetings. Share all the information, put it on the table, put the dead cats on the table. Go through system by system by system by system. Get out in the road, visit other companies. They all do things better than you. Learn, and be relentless about doing it. Big companies slow down, they become complacent, they become bureaucratic, all that stuff, arrogant, is the petri dish of politics. As Jeff Bezos says, that kind of stuff leads to stasis and death. And if you don't believe me, you look at all the companies who failed, huge, wonderful companies. And it was because of things like that. So I'm kind of relentless about driving stuff. Nothing's too small to care about. So when I go around my company, I was listening to you talk about, Chris running Hilton. Nothing's too small to care about. Hey, Chris, I want to be able to read when I'm having shampoo or conditioner, okay? That's my one big beef. And also, one button to turn off all the lights when you get into these fancy rooms or something like that.
I know.
And you're tired and you're going to go to bed. So that's what management is. It's relentless attention to detail, getting strategy right, investing your capital, not being beholden to people. But the most important is that the people at the company can contribute to the best of their ability. They know that you, the boss, don't know everything. And they know that you just want to do the right thing for the company, the client, or the community. And that's the only goal. There's no other goal. We don't pander to Wall Street about quarterly earnings or stuff like that. I've never spent any time in that in my life. Just try to do the right thing for the right reason and do it quickly.
Now, you used to, I don't know if you still do this, how technologically proficient you are, but you used to come in every morning with a list of things to do. You wrote it down on the handwriting.
I hesitate to do this because there's TV out there, and so the TV's going to zoom in on it. I did that once with a credit card. They took my number and immediately got stolen by criminals. And yeah.
So,
does anything bad about the press on here?
Okay, so now many people in the business world, they're out socializing, all kinds of other organizations. You don't do anything. You just run your bank and you spend time with your family. Isn't that boring?
No. I love my family. I love all of them. I got 7 grandkids and 1 more coming. We take our family vacations together. That's the most important thing. The second most important thing is my country, that I do spend time on. You know, with my own time, my own effort. My company obviously gets involved. I love business. I think if she's talking about I don't do a lot of black ties. I don't play golf. I don't do red carpets. I do a little bit, but I love what I do. I mean, it's not like, I don't feel like I have any regrets at all about doing that. And I feel, if JPMorgan Chase does well, I can help our employees, I help my clients, I help my communities, I help my country, I help the world, if I do a good job. I always tell people, if we don't keep JPMorgan healthy and vibrant, I cannot do those things. That's when the other side of that. You gotta lay people off, it's miserable, your life is terrible, and so I fight hard to make sure we're healthy and vibrant.
Now, you flirted at times with maybe running for president of the United States. Are you still thinking maybe you would ever do that?
Yeah, I never really flirted with it. Oh. I simply asked someone once, what does it entail?
Okay.
And they told me. That was it.
All right.
And it entails a lot.
Well,
I mean, it is a huge thing, but I love what I do, and this is what I intend to be doing.
Right. So suppose a president of the United States said, I'd like you to be Secretary of the Treasury or Chairman of the Federal Reserve Board. What would you say to that?
Well, Chairman of the Fed, I'd put in the absolutely, positively, no chance, no way, no how, for any reason.
Okay.
Secretary of Treasury, I would consider, if a president calls you up and asks you to do something, you should consider it. So I would take the call and consider it and think about why and what they want, et cetera. But what they want and how they want to operate, that would be important to me. I like my job. I've been my own boss for pretty much 25 years, and I like it that way. I was in Peru at the APEC meeting or something like that, and I was coming on stage like this, a televised thing, and as I was walking up, the person who questioned me, I think it was from Bloomberg, said, the president just tweeted that he likes you or something like that, but you're not going to be Secretary of Treasury. And she asked me on national TV. So I said, that's good because I like being my own boss.
So when
we both like it that way.
When the Great Recession happened, were you worried about the viability of our financial system? Your bank was in pretty good shape. Were we worried that many investment banks and commercial banks were going to go under at that time?
Yeah, well, a lot of them did. And yeah, a lot of companies around the world, a lot of non-banks around the world went bankrupt. JPMorgan, we did a lot to keep people afloat. We took a lot of risk to do that. We worked with governments around the world. It was terrifying. And it was, 24/7, and, people were just trying to do the right thing to make sure, we kept the...
Do you think there's a chance of something like that happening next couple of years? Do you think we're much better protected from that kind of problem?
Well, there's no chance that you're going to have that kind of problem. But, there are chances to have a problem somewhere, somehow. The biggest unknown is geopolitics, and it's not like, and you have to be careful you talk about it. It's not like that's going to determine what the economy does in 2026, but it is a moving tectonic plate. Alliances, obviously there's terrible war in Ukraine, which we need to do as much as we can to help Ukraine, but aided and abetted by and Russia, somewhat by China. Those folks have told you what they want to do. They want to dismantle their system set up, they think, by America, but it's set up by the Western world. After World War II, it's been quite successful. Yeah, there are a lot of forces at play. And, and people are going to have to choose, how they want to play this for now. So, yeah, that would be my greatest concern. And that's about the future of the free democratic world. That's not just about America.
Are you worried about the over-regulation that some people in the banking world think that is occurring now, or do you think the regulations are okay now?
My biggest, the problem with regulations, when you talk to some people, it's always act like it's more or less. Well, and a lot of you deal with regulations. I think you can create more liquidity in the system, more capital uses, more lending capability, reduce rules and regulations which cause, when there's complaints about debanking and complaints about X, I think we could make the system better, work better, cheaper, work for more Americans, and safer. And what bothers me the most is when we talk about regulations, that no one ever steps back and say, what are we trying to accomplish? Or why do we want to accomplish it? And what's better, this or that? Because no matter what you do, there are pros and cons. So take the system as, banks are very strong today, but take the system as a whole. We've gone from 8,000 public companies to 4,000 public companies. Is that what we wanted? Because that's what we did. We did it with no forethought, without even thinking about it. But it was, years of rules and regulations that made it costly and litigious and hard. And, we let institutions like ISS and Glass Lewis, vote 30% of the shares in America. And so, yeah, I'm quite concerned about that we get regulations right. We all want safe financial system, a safe food, and safe, but it doesn't mean you have to have endless regulations. Regulations should be reviewed and improved all the time, as opposed to what we do today. I put that in a lot of policy. We just add things on top of things. And if you look at policy in America, well, our affordable housing, it's all about policy. Zoning policies, permitting policies, housing policies. It's all about policy. It's got not a damn thing to do that people don't want to build homes or move into homes. And I could say it's about a mortgage business. We made it more expensive because of rules and regulations. Education. We don't measure the outcomes of high schools and community colleges and colleges. How many jobs do they get at what income levels? And we can do it. So look at work skills. We're going to need 200,000 welders. We need welding schools. So if government's going to have policy, it should have policy that aids and abets and incents and has the guardrails to create the right behaviors, not endless policies that slow things down, which is what we have. We're slowly going the way of Europe. Europe, you may not know this, has gone from 90% per person GDP of America to 65%. That's what they've done. It was all policy. A lot of the policy done in the name of good. And that's what we do all the time. We're endless, rules and regulations that create these things. I also think you all should learn to call it not red tape, but blue tape. Blue tape. Okay? The Democrats love that crap. And then they want to make it litigious. That every flaw that ever happens is on purpose by bad people. So policy, we need good policy. And we're going to be fighting much more for good policy this year at JPMorgan.
So recently, there's been some comment by you about the independence of the Federal Reserve Board. What more might you want to say about your view about the importance of the independence of the Federal Reserve Board?
Yeah, people, too much ink gets spilled on certain things. Everyone I know, including the President of the United States, says we need an independent Fed board. Most people I know, including the President of the United States, speak up about their opinion, which they're free to do. Some say it more aggressively than others. That's their right. The question is only about when certain things take place, and think of lawsuits and stuff like that, does it chip away at that independence? There's some spectrum. So you can say a little bit, you can say a lot, but you don't want to chip away too much, because if you chip away too much, in my view, this is my opinion, it will drive rates higher, not lower. That's all.
And that's not a job you would take. If the President of the United States said to you, I'd love you to be the chairman, you'll be very independent, you wouldn't take that.
I would so much more prefer this job than that job. That's a hard job, but I don't want to do that job.
Okay. So Warren Buffett more or less invented the idea of writing a letter to his shareholders that everybody reads. You have done the same, and now Warren Buffett's probably not going to write his letter anymore, and yours is widely read. How much time do you put into writing that letter, and do you get nervous that so many people are going to pay attention to every single word? You have to get it exactly right?
Yeah, I do all of that. So first of all, I've been reading his letters my whole life. And in fact, I got his letters from 1956 when it was a partnership in private. And he said you should speak to your shareholder like it's your smart sister or mother or something like that. Explain to them what you're doing and why you're doing it. So I do that. I make a list of questions. I get the questions. I do it myself. I ask shareholders. I get my management team, or like, what is the most important stuff for JPMorgan? And I kind of make that list. I start writing. I spend a lot of time on it. Very often I use it to answer the question. I don't know the answer, and I actually do the work. So now I'm like doing a lot of research while I'm writing the letter to answer the question, what are we going to do? Is what we did the right thing? Should we do more of it? How are we going to use AI or open banking or whatever the question is, debanking? What is the real issue? Then I try to explain it in terms to our people. And then I started doing public policy because no bank is actually much stronger than the country it lives in. And and Suzanne showed you that 3% growth versus 1% growth. You don't know how accurate that is about what it does. So I had done, this goes back, but America from 2000 to 2020 grew 2% a year. Had it grown 3% a year, which I think was eminently achievable, our GDP per person would be $20,000 more a year today, per person, which would afford a lot of safety nets, a lot of infrastructure, have a lot of taxes, and we didn't do it. And it's around basic things. So I started to do more of that. What are the things that we could do that can foster growth, secure the country, make it a healthier place, lift up all of our citizens? Here's another one. Almost all of the bad policies we have, the thing that inner city schools don't work, immigration policy, some of the stuff we do in immigration, permitting policies, schools, almost all of that hurts lower paid people more than anyone in this room. So in some ways, we could ignore it because it's not really affecting us directly because your kids don't go to those schools. You're not as worried about that. The lower income folks have worse health care, worse job prospects. It's become intergenerational. Their schools don't work. They have more crime. And that's what we did. That was us. That was all policy. And and then people stand behind ideology or morality, on both sides, thinking that they did stuff to fix it, and they didn't. And so I have a frustration around that. And obviously, I feel the same way about the security and resiliency things like permitting. I always make a list of how we do with mortgages and affordable housing. So we may start a new one called the American Dream. We do a lot to do mortgages, affordable housing, health care, skills, jobs. I would double the earned income tax credit or something like that. There are a lot of things we could do that would grow us to 3% and help all of our citizens and secure the nation. And we better do it pretty quick because on the security side, we don't have forever.
Now, are you worried about the size of the U.S. debt? We have $38 trillion of debt. We're adding $2 trillion every year. Do you see any way that's going to be solved? And do you worry that this is going to impact the value of the dollar at some point?
Yeah, so so I agree with Chris. If you look at the economy today, there's a lot of good short-term things. Like think of this year. The one big, beautiful bill, there's a lot of stimulus. The Fed is buying bonds again. That's, they don't call it QE. I would, but it lifts up asset prices and stabilizes certain markets. Deregulation is real, and it's going to also drive animal spirits. A lot of investment coming to the United States and AI. That's all good, and that's probably going to drive stuff. I call this geopolitics and the deficit. I call those more like tectonic plates. They're difficult. They're moving. They may crash. We don't know, and we don't know when. So it isn't a 2026 issue, but our deficit is almost $2 trillion this year. Our total debt is $30 trillion. Then it's going to be next year 32, then 34, then 37, then 40. It is not sustainable. It will not work eventually. I just don't know when that is. The best anecdote is growth. I mean, if you just model anything, growth will make up for it. And growth, I always tell people, good policy is free. Good policy is free, for God's sakes. Like, we already spent $800 billion in K-12. Stopping people from building stuff, it's free. It'll create jobs, it'll create productivity. And so, yeah, that I do quite worry about that. I think that when we have time. We have time to get the policy right, to grow the economy, and then we're going to have to start making some other choices, too.
So you know Warren Buffett and you admire him. Recently, you hired somebody that was working for Warren Buffett and to come do some investing for you. Was that difficult to call Warren Buffett and say, I'm taking one of your people, or he didn't really care?
No, because I think it's a free country and people can make their own decisions. And I did call Warren, and he probably wouldn't have preferred it, but he said if he's going anywhere, at least he's going to you. He was on my board, so I knew him. And I'm thrilled to have him. He's just a high-class individual, a brilliant investor. We have a lot of incoming ideas to invest in. So you're going to see us do investments in some of these security and resilience-related companies, from the venture side to more of a merchant banking, large type of deal or something like that. So, but he was an individual. He'd been with Warren for 16 years. He loved it. He was already thinking about what he really wanted to do in the next stage of his life. But this was like a patriotic move. It's different. He's loving it. He has an office on our floor. He's seen people we all know all the time. And it's been just a great add to the company. So,
of all the things you do, is the most enjoyable getting to meet with members of Congress? When you come down here, is that an uplifting experience when you come down to meet with members? How do you like that?
So you should know, I do it all the time. I think it's, it's part of my job. Years ago, I said, government is another line of business. It is. We take it seriously, and to make an important point here, and the chamber does this, which I think they do a great job. Congratulations, Suzanne and Ross. You got to get engaged. It's very easy to say no. There are a lot of people in the Congress, House and Senate, who want to do the right job. And they need help to do the right job. I'm not insulting their intelligence, they're quite bright, but they need the research, the facts, the analysis to figure out what to do when these complex issues come up. So I think we all need to do it. And the only thing I would urge you all to do when you do it, don't always make it parochial about your own self-interest. It should also be about what's in the interest of the United States of America. You're all gonna do fine anyway. And there's just too much. This happens from everyone. It happens from unions and government and businesses, where the self-interest is so high, it actually is part of why we have 2% growth. And I think we should all open our eyes a little bit, and make sure we do the right things. It's okay to fight for for you, for your own interest, but there's too much of that going on.
A lot of people in the top levels of financial world have found it difficult to have only one spouse. You've managed to have one spouse for how many years now?
I have a wonderful, unbelievable spouse, but one is enough.
Okay. All right. And so what do you do in your spare time? I mean, you can't be working all the time. Do you have any hobbies? Do anything other than worry about the JPMorgan?
Yeah, so my daughters, who I also love deeply, and I have wonderful son-in-laws, one said to me, "Dad, you need more hobbies." And I was like, "Wait, what are you talking about?" We take all our family vacations together, around the world. We enjoy it. I love history, I love wine, I love music, I love reading, I love arts, I love, we watch movies together. That's what I like.
Okay.
I'm not looking to do other stuff. And we hike together. We used to play tennis together. I can't play tennis anymore. So that's what I like. Those are my sports. We all do the gym together. We have lunches and dinners together. We have family dinners almost every Saturday or Sunday night. That's what I like, and that's what I'm going to do until I'm no longer here.
And have you ever had your credit card denied? I mean, you have a lot of. Has anybody ever denied Jamie Dimon?
Yes. My own credit card has denied me several times, and I'm sitting there.
And what do you do? You tell them who you are?
Well, it doesn't work to tell them who you are. They don't know who I am. Fortunately, I'm usually with someone else, and I said, "Take your card out." But it's sometimes for very good reason, because the card was stolen. And that number would be used, and they would just want to stop it. We have better algorithms now where, even if my card was stolen, if I'm going to the same restaurant I've always gone to, it can get approved. Even though the number is already out in the marketplace trying to be used to buy TVs or jewelry somewhere or something like that. The most annoying, and I get these complaints, and very often I get complaints, they say, "Well, that's our rules." I'm like, they say, "Yeah, that may be our rule, but it's not the way to treat someone." And, we had someone who didn't pay, a very good client. They had a credit card. They spent, thousands of dollars a month. They always didn't pay on time, which happens to some of you too. And then the wife went to buy a bagel at a bagel store, and it got turned down. And I'm like, really? Really? Is that how we should treat? So change the goddamn policy, And because they hadn't paid $100 minimum balance or something like that. So yeah, you have to fight hard to make everything better all the time. And the first way you do that is you and your teams should read these things, like customer complaints, go to the call centers, go to the branch. I ask people at the branch, what's the biggest complaint you have? And sometimes they tell me, I say, why do we do that? Why would we do that? From opening, I remember going in Chicago, it was freezing out, and the branch was supposed to open at 10, there's all day hanging out, it's 10, it's 10:01, and they finally open the rest. And they say, well, that's the rule. They can't open until 10. I said, when that little lady's next time, open the door. Give her a hot cup of coffee. So now I mandate, you got to open the doors, which we better still be doing, by the way, 10 or 15 minutes ahead of time. I don't want to hear that crap. Treat people the way you want to be treated, and if our policies don't work, rewrite them.
Now, did your parents live to see your success, and what did they say? Did they say, we always knew you were going to be the CEO of JPMorgan, it was going to do well, or what did they say? My mom had a little of that. You'll be a general one day or something like that. But they both died in 2016, literally together in the same bed, same within 12 hours of each other. So they got to see a lot of it, and we're quite proud. My grandparents were all Greek immigrants who didn't finish high school. So I'm part of that story. And they instilled in all of us, values, and the values were have a purpose, work hard, make the world a better place, treat everyone properly and equally. And they got to see that. So they're proud of all of their sons. My twin brother's an educator. My older brother is a physicist. And so it wasn't about, my dad was a broker, but it wasn't about going to financial services. It was about, making the world a better place. Values I'm sure a lot of you have. Do you have a twin brother?
I have a twin brother.
And is that easy being Jamie Dimon's twin brother, you think?
No, he loves me, and vice versa. And having a twin brother is an unbelievable thing. And so of course early on we fought and up. You got close over time. We adore his wife. He comes over to a lot of those family dinners. And when I had cancer, he came to see me every freaking day.
And you're fully recovered now from your cancer?
Yeah, no, I'm fully recovered, yeah.
And how many times do people think that you are, because you're in the financial service world, you're Jewish? You get a lot of that? Did you get a lot of that?
It's that, and my name is Dimon, but it would have been Demetriou. So it's like an Ellis Island shortened name. And my wife's last name was Kent, and she is Jewish. So a lot of people do.
So final question.
But my kids, I hate anti-Semitism. So I'm just make that clear. And it should be fought everywhere, all the time.
Final question. What would you like people to know the most about JPMorgan? If they walk away from here today, what would you like people to take back in their head about JPMorgan, about what it is, what it's done, or what it stands for?
That we will stand by good clients than thick or thin, that we always try to be better, that we are strong, but that strength is for you, that we want the community to be better, we want your companies to be better, we want the country to be better. We'll do our part making this a better world. And we do it with a forethought and with every sinew of our bodies to try to do the best we can. And we, God knows we make mistakes, we will say we made a mistake, we're sorry, and we'll fix it. That's what we'll do. And
well, congratulations on your success. Thanks for being here.
David, thank you. Enjoyed it.
Thanks a lot. Thanks a lot. Bye.
Thank you. Oh, thank you very much.
And that, of course, was JPMorgan CEO Jamie Dimon speaking with David Rubenstein at the U.S. Chamber of Commerce. Really interesting, wide-ranging discussion.
Are you sure that was Jamie Dimon?
I'm
because
pretty sure.
Probably the most newsworthy bit out of this is that he has a twin brother, which I never knew about.
I was shocked
to hear it. And now I'm
it.
questioning every time I've ever seen him whether that was really him
Maybe
or his brother
that's the
Ted.
secret to longevity. They're just switching them out there. But yeah, Ted and Jamie Dimon, definitely a little fun fact that we learned there. But let's discuss all of it with Bloomberg's chief Wall Street correspondent, Sri Natarajan, as well as finance reporter Katherine Doherty. Sri, I'll start with you. So the interview started off with the question, the age-old question for Jamie Dimon. When are you going to retire? What's next? And I don't think we got an answer.
But did you notice a variation to his usual joke answer? He always says at least 5 more years. This time he said at least 5 more years, at least, which at least tells me we're not counting down from 5, 4, 3, 2, 1. We're now going 5, 6, 7, 8. So 69-year-old Jamie Dimon wants to be there for a little while longer for sure.
Keep going, Katie Greifel.
Okay, so, 69, he looks great. We also learned that he doesn't golf, but he does go to the gym with his daughters. It was interesting that we didn't necessarily hear his thoughts on credit cards and potentially rates. And that was interesting, Katherine, because I have to imagine he has a lot of opinions.
Well, he did express actually some frustration with his own experience and being denied. He was asked the question, have your credit cards ever not worked when you walk into a merchant store? And the answer was Yes. And he then started going into, and this is something that came up a lot, his rants about policy. He is acknowledging that things actually do need to change. Now, he is not the one that's coming forth and proposing the 10% cap on credit cards. That would hurt his business. But he is saying that the way that things work, there could be changes to make the consumer experience more efficient. Think about the actual person rather than maybe the business. And this came up a lot. He was really presenting himself not just as the CEO of the biggest U.S. bank, but he was using the phrase, I'm a patriot, bringing up a lot about the country and the U.S. And I think that to me stood out as a major theme in his
I was surprised. Well, not surprised. He's used that word before, but also the idea that he tries to characterize it like that. Also, some of the colorful language he used with regards to regulation. I thought his little quip about stop calling it red tape, blue tape, and then his dig at Democrats. One thing I do want to zero in on is, he kind of referenced all the talk about why he never really entered politics in some sort of formal capacity. And he referenced that Lisa Abramowitz's interview from, I think, November, where she asked him about whether he would join the Trump administration. He said, I haven't had a boss for 25 years. But it gets to the idea, I know 69 isn't young, but it's not old either. I mean, do you think there's any possibility that maybe he would warm up to some sort of a formal political position of some sort?
I think the climate in D.C. has to change. Right now, the bigger question is, does the current climate in D.C. allow for a Jamie Dimon to be there? Would there be any administration that will say, let us bring in Jamie Dimon? Certainly doesn't feel like it in a Donald Trump administration. And if you think about a Democratic establishment, look at the language Jamie Dimon has been using about them. Does it feel like when the Democrats come into power, they would want Jamie Dimon as Treasury Secretary? Probably not. But he's clearly said he's open to it. And he's always said that, at least the Treasury Secretary role, if not the Fed chair role. The other interesting thing to me about the Fed chair comments were he said that a lot of ink is spilled on it, but I can assure you that no one I've spoken to, including the president, thinks that the independence of the Fed is not critically important. But if you have been paying attention to Donald Trump, I don't think he's necessarily on the same page as every other big business leader.
At least he hasn't said it word for word. I did find that comment to be interesting. Also, when he answered, he said absolutely, positively no chance when asked about the Fed chair position. And then as it relates to Treasury, he used that same commentary of if the president calls, if the president asks, you at least consider it. But if he was to be called and asked about the Fed chair position, if he's saying so blatantly that he would never consider something like that, it just shows a little bit of a variation here and parsing through his
But also,
language.
can you put into context, too, kind of his influence? I mean, we know he's very well respected on Wall Street. And he may not be a household name for the average voter, but he certainly carries a lot of weight in Washington. I would say probably more so than most of the other bank CEOs that are always trying to get the ear of Congress or the president. And it gets to this idea of why not have a Trump or anyone in that administration just trying to draw in Jamie Dimon on their side.
Look, absolutely. There's no doubt that he is the top dog on Wall Street. He is the loudest voice on Wall Street, and he's a respected voice. And that happens when you're running the nation's biggest, most successful bank over 20 years. But the question really comes back down to politics, especially with the populist pivot, which you have seen even with this Trump administration. How do you necessarily tell your base that the best idea is to have a fat cat Wall Street CEO as the person who should be guiding the economy when there is so much underlying frustration on Main Street? Not my words. I'm saying that's the perception out there about leaders like him.
But not to be pedantic, we have a lot of fat cat Wall Street people running our government right now. Katherine, I'll give you the last word. I'll let you off the hook there, Sri. I'll give you the last word. And this really goes back to the idea of his longevity at 69, not only at his age, but obviously his tenure at the helm of JPMorgan. Is there a succession plan? Have they articulated a succession plan in some way? And if he does stick around for 5, 6, however many more years, does that upset that succession plan? Because if you are qualified enough to be a successor, why would you sit there for 5, 6, 7, 8 more years?
I think they absolutely, in the last few years, the last year or so, they've set up some executives that is at least signaling that they have people in mind. Now, Sri made a great point earlier about if you have those people and they're set up now, they might stick around in those positions for the next year or two and see not just how the bank is progressing, but how much experience are they actually able, how much is Jamie willing to give up of his own responsibilities? Because at a point when you are thinking about succession, you can't hold on so tightly. He seems very engaged to me at this point in time. And so if in the next 2 years he's still so engaged, those executives haven't really been able to showcase what they can actually do, then it becomes a question for them of whether they stick around and still try to see, is he actually in the next 5 years going to step aside, or does he keep being fulfilled with the work he clearly is saying today again and again, I enjoy the work that I'm doing. And I think that he sees a direction that the company is going. He talked a lot about this new building and how inspired he gets coming in and seeing the American flag right as he walks in the door. I think there are things that really help him get up and be inspired to come in to do the job he's doing.
Now, you've eaten dinner in that building, right?
I haven't eaten dinner.
The 25 restaurants in the
I
middle there or
haven't. One
something?
of our producers has.
Oh.
I have seen the flag in the lobby. Has its own fan, so it's always waving.
All right. Katherine, Doherty, and Sri Natarajan, who helped to lead our coverage of Wall Street here. A great interview with JPMorgan CEO Jamie Dimon and David Rubenstein. Meanwhile, we go back to the markets here and we look at the seesaw in oil prices and oil stocks. A seesaw on the back of public policy and, more importantly, what the potential reaction by President Trump and the White House will be to Iran. For right now, the president's saying that he is holding off on attacking Iran. The unexpected move comes in response to Iran saying it would not execute its protesters. Joining us right now to talk a little bit more about this is Amos Hochstein. He's former senior advisor and deputy assistant to President Biden. He's now a managing partner at the investment company TWG Global. I do want to start off with this idea of the pullback, which I assume might be temporary. And I know there's a lot that we don't know. But given your expertise, given the fact you've been involved in security negotiations between Israel and Lebanon, Israel and Hezbollah, Israel and dang near everyone who's been trying to attack it, what does the complexion of U.S. involvement in this, I guess we can just call it right now, a potential uprising there in Iran look like?
So it's good to be with you. Yeah, this is, a very fluid situation. The protest started just a couple of weeks ago, and President Trump had vowed that help was on the way and encouraged protesters to go. What we do know is that the regime, unlike in previous times, had a brutal crackdown, a massacre of potentially over 10,000 people in literally 2 or 3 days. So just an extraordinary massacre of its own people. And as a result of that, the United States government was looking to take some action to support the protesters. We know that those protesters probably subsided after Saturday. The brutal crackdown succeeded. And I think so there's been a little bit of, did we miss the window of reverting? And the second is, this is not Venezuela. You can't just take out the supreme leader. Who comes next is probably the IRGC.
Well, that's what I'm curious about here, because, based on some of the news reporting, and there's a lot we don't know about the location right now of the leader, the location of some of their money and their gold, the positioning of U.S. warships in that region. For some reason, the regime that has existed for the last couple of decades, if they are indeed done, is there a plan out there, whether led by the U.S. or led by some sort of international coalition, to fill that vacuum? Or is this going to be a situation where we're just going to deal with a rogue state for years to come?
So I think the questions that you're raising are exactly right. So number one, we moved a lot of assets, military assets, from the Mediterranean, from the Red Sea, to the Caribbean, in order to put pressure on Maduro and on Venezuela. So we also were in a position where when these protests happened, we didn't have the kind of assets that we normally have in the region. We went from 2 aircraft carriers to 0, et cetera. So that's number one. Number two, your point on who comes next is exactly right. And what you don't want is an Iraq, right, or a Libya, where you end up with a failed state that has several organizations with, or entities with, a lot of weapons and no opposition. There's currently no leadership to the opposition, except for, to some degree, the late Shah's son, who lives in Maryland, who has become sort of a romantic figure to some in Maryland, in Tehran, but not clear that he has actual support. So I think that there's now, part of the problem is when you say help's on the way and then it doesn't come, it also crushes the spirit of those protesters who bravely turned out in the face of a crackdown. But I think where we are today is that it looks like, at the very least, a strike by the United States, a military strike, is put off, but we don't know by how long. And whether or not the Iranians have been able to stabilize the streets and the country. But the regime as we knew it a month ago is probably on its last legs now.
Well, Amos, I actually want to broaden out here and talk about all the different engagements that the U.S. has in the world today. There was a really interesting piece in The Atlantic yesterday, the title of which was "The U.S. Military Can't Do Everything at Once." And the columnist writes that Pentagon officials are privately warning that the U.S. may not be able to threaten Venezuela's regime, support protesters seeking to topple Iran's government, and protect its interests in the Asia-Pacific without being overstretched. And I wonder where you fall on that question, whether or not the U.S. military is spread a little thin here.
Especially if we're going to do a military invasion of Greenland, in addition to all that. Look, I think what we saw in the last couple of days is exactly the problem. When you move all your assets from the Middle East to the Caribbean, and then you get stuck with, not having the assets in the right place, is a demonstration of what you just described. And we are in a place where we really need to pay attention to what's happening in the Indo-Pacific, not because we're going to go to war, but because we have to have a deterrence in the Indo-Pacific. We have to maintain at all times a certain level of military presence in the Red Sea in the Middle East, because the volatility is too high. We have a lot of troops there. We have to make sure that we protect our interests and our allies. Right. So I think you have to pick your poison at some point and say, what is the most critical point? Which is why we need to stay in NATO to leverage that force multiplier that is NATO, and we need to decide what is the most important.
Amos, unfortunately, we're up against the clock. Hope to have you back soon. Fascinating conversation. That is Amos Hochstein. He is former senior advisor and deputy assistant to President Biden. This is Bloomberg.
It was a strong 2025 for the big auction houses. Christie's actually reached $6.2 billion in sales, up about 6%. As for what's in store for 2026, well, we caught up with the CEO of Christie's, Brennan. Here's what she had to say.
We try to build sales being responsive to what we see from past seasons, but sometimes it's that incredible story that really brings people out. We are really storytellers in our business, and last year we were really lucky because of the stability in the first half. And some great stories there. It unlocked even more in the fall.
I'm glad you used that word storytelling, because one interesting stat that I saw was that almost like a quarter of art sales, at least the big ones that Christie's and Sotheby's and those do, are now pretty much single source collections, basically estate collections and such. And that's like triple what it was even just like a decade ago. I'm curious, though, does that require, though, a bit more storytelling when you're dealing with kind of these singular collections from one particular family or estate?
Each one is different. So I would say the storytelling is key if it's about the artist. Sometimes it's about the work. Sometimes, as you mentioned last year, a good example, it's about the collector. It's about, in the spring we had the Len Riggio, who founded Barnes & Noble. Yeah. Great story there. In the fall we had the collection, for example, of Elaine Wynn, a great philanthropist, collector. They shut down the Strip in Las Vegas when she passed away. So each collector really brings their own passion, and it gives us such a great sort of reason to tell a different story.
I'd love to talk a little bit about who is bidding, and I want to start with where, because Christie's, it's particularly strong when it comes to the U.S., but you think about the luxury market worldwide, there's been concerns about what we're seeing in China, Europe as well. So, you talk about how 2025, best year in 3 years, but how did it break down by geography?
America is our biggest region. It's about half of our business. Then Europe. And then Asia actually was just over 25%. Asia is really an incredible gateway for us in terms of new buyers, younger buyers. Half of take luxury, for example. Luxury was up last year. Even though the talk of the tariffs, our luxury sales, which we consider jewelry, wine, watches, handbags, cars, vintage cars, up 17% over 24. A number of those buyers and first-time buyers are coming from the Asia market.
Well, yeah, I'm glad you brought up younger buyers, because that's something I wonder about. You think about millennials, for example. It seems like the taste for, framed artwork, fine art, has sort of been ceded to a lot of those luxury items that you mentioned. You think about collectibles when it comes to cars, comes to handbags. So are you seeing that trend as well? And how do you consistently meet and attract that younger buyer?
That's our biggest goal, is to make sure that we keep that pipeline of new clients, new friends of Christie's coming to us. We had a really interesting stat that in 24, a new buyer average spend was about $22,000. Last year, that buyer came back and spent 50% more, and they bought in other categories. So we love sort of getting them in, whether it's buying a watch or a piece of jewelry, but exposing them to, say, prints and multiples or contemporary art or 20th century design. And we're seeing that in the numbers. They are transferring over, which is great.
We'll talk about kind of the diversification of offerings, because when we talk about these younger people who have the money and the interest in investing in this stuff, they're not necessarily just looking for the Picassos and the Kuhns and things that the older generations might have done. I was looking at your calendar for 2026. One that jumped out at me was Jim Irsay, who used to own the Indianapolis Colts, has passed on. You're going to auction a lot of this stuff, but this isn't like Monets and Rembrandts and things like that. Talk a little bit about what that is.
Jim Irsay was such a passionate collector, and looking at his collection, 400 objects, tells us really the history of pop culture of the last 100 years. Some examples: the saddle worn by Secretariat, the Triple Crown horse, Muhammad Ali's championship belt when he beat George Foreman in that famous fight, Kurt Cobain's guitar that he used in the video to Smells Like Teen Spirit. There's a lot of talk about the dead this week with the passing of Bob Weir. We're going to sell one of Jerry Garcia's guitars called Tiger. So a really interesting collection. He was so passionate, and that's a wonderful story of this larger-than-life guy who wanted these really unique and special objects.
What is next for a company that is 260 years old at a time in our society where so many things have shifted? Interests, wealth, and of course the demographics of that wealth.
Yeah, my key priority, as I said earlier, is making those new connections with people. We have to continue to innovate and evolve. We can't get stuck in what we did 50 years or 100 years ago. So that involves technology. That involves looking at different categories. It's why we bought a car auction house. It's why we're expanding geographically to places like Saudi Arabia. Being nimble and responsive and being brave enough to evolve. We have a durable brand, and we should remember that and be thoughtful and innovative.
And our thanks again to Christie CEO Bonnie Brennan. This is The Close on Bloomberg.
All right, as we wrap up our coverage here on this Thursday afternoon, a push ahead to what the markets will have their eyes on over the next 24 hours. The earnings season continues starting tomorrow before the bell.
Absolutely. We get PNC, then we get State Street, another asset manager. BlackRock, of course, set the bar high with $14 trillion in assets.
Yeah, and that's actually going to round out some of the more bigger financial institutions as we get into next week. Look for the regional banks and, of course, the non-bank earnings. We're also going to get industrial production numbers at 9:15 a.m. tomorrow. A bit of a read here on the manufacturing economy.
Yeah, looking forward to that. And then we'll get a little bit of light when it comes to the housing market at 10 a.m. NAHB Housing Market Index comes out there.
Yeah, we actually saw a little bit of a strength in housing sales towards the end of last year. It'll be interesting to see what that index shows and whether we can sort of glean any sort of progress for the rest of this year. And Fed speak, I know you love them.
We certainly do. Jefferson, Bowman, and Collins, of course, hitting the stage. That next Fed decision coming January 28th.
And anything important they have to say, we'll bring it to you right here on The Close. In the meantime, stick around. Balance of Power is up next.